All right, well, welcome everyone today to this webinar, kind of regarding business valuation. We'll talk about basics and kind of get into some other approaches. We'll talk about kind of where our data comes from and our support, and what things that might impact value up or down. I'm Ryan McGregor. I'm an M&A director here at Lutz. I've been here 10 years now, and I'd say my main focus is around business valuation, transitions consulting, and just kind of overall arching consulting. Prior to Lutz, I was in banking and finance, so I kind of bring a unique perspective from a different side, more the financing arm and how even financial institutions look at a deal. So from a valuation standpoint, I can add, like I said, just some different skill sets to the mix, other than just simply running the approaches. So I will kind of turn over my co-presenter, Michael Gredeman, and he'll talk a little about himself.
Thanks, Ryan. Good morning, everyone, and thank you for joining us today. As Ryan said, my name is Michael Gredeman, and I'm a manager in the M&A group here at Lutz. I've been with Lutz for 4 years now and worked in business valuation for 6 years in total. So my main duties involve leading valuation engagements for a variety of purposes and assisting with business transactions, both internal and third-party sales. So as a CPA by trade, I kind of got in the accounting world and then switched over to the valuation world about 6 years ago.
Thanks, Mike. I appreciate that kind of overview. So Lutz in general, and if you've been on these webinars before, you're obviously familiar with Lutz. You've probably seen this slide several times, but I'll kind of touch on it. We've been around since 1980, and depending on the time of the year, busy season, we probably are 300, 350 plus from professionals over our 4 locations. You have Omaha, Lincoln, Grand Island, Hastings. But kind of the main thing, obviously, is we're local with clearly a national presence. When you have that many employees, we touch several different industries, several different skill sets. Within, I would say, our little niche, our M&A, there's 3 real main focuses that we like to bring, and that is valuation, business valuation, sell-side advisory. Sell-side, we're not going to touch on today, but long story short, it's where we will actually market companies. We'll take them out. We'll come up with a buyer list and come up with the marketing materials to be able to present that company in a light that hopefully intrigues a potential buyer to offer the obviously premium price. The third kind of, if you want to say, leg to the stool would be the transaction advisor service. That's kind of the newest part of Lutz M&A, and this is truly kind of quality of earnings, where we will go in and try to validate any add backs and validate the actual cash flow to help with potential buyer acquirers decision making at the end of the day. So this is from a webinar, we'll kind of focus on the valuation side, but I wanted to get at a high level that we do obviously do other things within the Lutz M&A umbrella. Within this, there is 10 dedicated individuals, different obviously skill sets. Some, like I said, more focused on valuation. Some individuals focus more on the sell side advisory as well as the transaction advisory. But what the main focus of this slide is just kind of show the depth and the breadth that our team can actually provide at the end of the day when it comes to valuation or the other functions that we do.
Thanks.
I'll turn it over to Mike in regards to kind of those credentials.
Thanks, Ryan. To start off with, I thought it'd be useful to talk a little bit about some of the education licenses required for us to work full-time in business valuation. So like any professional occupation, our M&A team has gone through different programs and courses that establish the frameworks and education components necessary to perform valuations. I imagine that a lot of the participants today are CPAs, so you're familiar with the American Institute of Certified Public Accountants, or the AICPA. So that's a big one. I'm a CPA, and the valuation designation under that is the Accredited in Business Valuation, or the ABV. I like to kind of consider that, you call it the 5th and 6th parts of the exam in terms of I think it was 8 hours of testing. You had to take some different courses to go through the curriculum. But, with that, we also do some forensic work. Bill Kennedy, who leads our group, he's a CFF, or certified in financial forensics. So that kind of falls within what we do. Also, another group is the National Association of Certified Valuators and Analysts, or NACVA. So Ryan's a CVA, very similar to the accredited in business valuation designation, in that, it's a curriculum. You have to learn, read different textbooks, and take a test to, develop your skills. Then obviously maintain CPE hours on top of that. And then lastly, given the M&A work we do, there is another organization that it's called the Alliance of Merger and Acquisition Advisors, but it's another training that kind of goes in through some of the tax and legal standpoints in working through a transaction. So this is, that not that important for the presentation, but just wanted to include it here to, demonstrate that, all 10 people, all 10 members of our group here have gone through different programs and different certifications to, become educated. And it's kind of always a changing world with different prices paid for transactions. So the CPE and the different, continuing education events that we participate in, they kind of help us to stay abridged of the most recent, things in the industry. Okay, so I thought it'd be helpful also to kind of go through. So say, for instance, somebody comes to us at Let's M&A for evaluation for a different purpose. So these are kind of the different questions that we'll kind of have to probe initially to figure out how best to serve the client and what work product they need. So why is the valuation needed? Who is the intended user? What type of valuation engagement? So this is more in the nitty gritty of our world, but the types of valuation engagements, standard of values, characteristics of value versus, controlling versus non-controlling, marketable versus non-marketable, and is the company viable? Are they going concern, or do we have to look at it from more of a liquidation premise of value? So these next few slides, we'll get into some of these questions here in more detail. So some different examples of why you would need evaluation done, or why you would come to us for evaluation. The first one's a pretty big part of the business that we do in terms of estate and gift tax planning. So with the current exemption amount for lifetime gifts for an individual being roughly $12 million and likely to sunset, I think in 2026 to closer to $5 million. We've seen a lot of business owners working with their attorneys to gift some of their interest in closely held businesses to different trusts or different beneficiaries in order to, use up some of that lifetime exemption while it is still, at the $12 million mark. So especially with COVID, with the change in administration, there were rumors that there was going to be a more rapid decrease in that lifetime exemption. So this has been a very hot area for valuations in the last couple of years, which has kept us busy. And then on the flip side, the estate tax valuation. So think if a business owner passes away, depending on the taxable estate or, a potential step up in basis on those shares, we may have to do an estate tax valuation to establish the value of their interest in a business as of the date of death.
Yeah, there's a lot to unpack on this one. We keep it just kind of like in the silo of estate and gift planning. But the biggest thing at the end of the day, when it comes to the gift planning is, what is your business worth? And that's usually where kind of the conversation starts is, okay, well, what's my asset? What's my personal balance sheet look like? Well, I own a business. Okay, what is that? Is that $500,000 or is that 5 million or is it 50 million? Right. And so if it starts getting into that $50 million range, at the end of the day, then you start to say, okay, well, what does this look like if I was to pass away? If I put the actual pieces and structure together to make sure that my family, it's a nice, easy transition, or that my business is able to, survive after that. So we kind of talk about estate and gift planning as it's just really kind of one sliver, but the reality of the matter is it kind of starts that whole process, which then gets into the other bullet points that we're walking down.
Yeah, thanks, Ryan. So another example is, obviously we're part of the M&A, mergers and acquisitions group. So if a if somebody comes to us seeking help on, establishing the price that they're going to pay for a business, or on the flip side, if a company wants to sell, we can kind of help determine a preliminary fair value with adjustments likely needed. But that's a part of the work we do. Bank financing. So a lot of SBA or Small Business Administration, SBA 7A loans, if they're over $250,000 in loan value, they may need an independent appraisal for the business, just to kind of make sure that they're maintaining with the relevant loan to value and other compliance items that the bank has to consider. So we'll do some 7A valuations. Employee stock compensation. So this is a pretty big bucket that ranges from establishing a 409A value in consideration of the IRS's rules around deferred compensation. Otherwise, we'll look at phantom plans and how do you incentivize management based off the increase in value through actual grants of stock to employees. So this is a big bucket of valuation work that we've done that has the potential to get complex, given some of the IRS rules around compensation. Buy, sell, or other stock transfer provisions. So, a closely held business likely has some type of transfer provision outlined in their operating agreement or bylaws that states, an owner getting bought out of the business has to be, taken at fair market value. So we help with quite a few of those engagements, just, the ins and outs of owners of closely held businesses. And this last bucket I kind of put together, but shareholder disputes or litigation support. So obviously not all business enterprises end amicably. They could, end in a divorce or the owners parting ways. So, depending on the circumstance, we may have to just help determine a fair value to each party, or get so far as, testifying as an expert witness, depending on if that goes to court from a legal perspective.
Yeah, and I would say those last three, in theory, bullet points are almost kind of intertangled. So if you have a decent, buy sell agreement that, once again, everyone is happy when you first start the business, right? Even in a marriage, right? You're happy, and then things happen along the way that, could be a dispute, could be whatever might be, but you want to separate. If the buy sell clearly states you go from A to B to C, it at least helps the conversation. Now, I'm a little hesitant to say put a formula within there, because the formula makes sense probably when you calculate it at that exact point in time. But what we've realized is, even in a formula function, especially with COVID, things may not have been appropriate. If you went back and looked 3 years, prior, or whatever it might be, might not be an exact formula. Sometimes I've seen where you put a triggering event in there. So a buyer wants to get in and out, a seller wants to get in and out, whatever it might be. But typically the buy sell is trying to avoid litigation, or at least the court aspect of litigation. You're trying to help with any sort of dispute. If there is a divorce, how does a person, transfer their shares, or what happens at that point? If it's disagreement or disability, how do people get in and out of that? So those are the things on like those last three bullet points to kind of consider if you're owning a company. Look at a buy sell if you don't, and have some things in there that helps this process.
Yep. And I think the one thing I would add to that statement is the fact that, oftentimes with the buy sell agreement, we will kind of help establish the initial value and, establish the understanding that the business will come back to us annually just for us to update our models. So you kind of have a fresh number each year. So then owners aren't unexpected or hit with unexpected changes if you haven't updated that number in 5 years. Then it's just better to stay up to date on some of those valuation metrics that, as a business owner, you're likely not looking at every day. Okay, so I mentioned, we may have to evaluate the valuation engagement that is required. So this gets a little technical, but the AICPA kind of establishes two different types of engagements. So a valuation engagement or a calculation engagement. Evaluation is going to be, I like to simplify it as, the analyst has the ability to choose whatever methods they think are best in terms of the valuation of the business, given, the industry and the company in general. versus a calculation. It's a more of an agreement that the client and the analyst will kind of work together and figure out, okay, we may evaluate the business on an asset approach and ignore the market and the income approach, or, we both think the income approach is best, so we'll ignore the other two. I'd say, evaluation, that is generally what is required for, the gift and estate tax world, given the IRS requirements. But we do quite a few calculation engagements in that, we'll work with the client and we want to establish a fair value that's fair to all parties. We're not really catering a value to anybody in particular. So the evaluation, it tends to be called a 75, 100, 125 page report with a lot of commentary narrative that costs more, whereas a calculation we can do for a lot less and still kind of have a good indication of value, but not have to go through all the procedures of a full valuation.
So when it comes to, once again, kind of checking the boxes from an IRS standpoint, the IRS, or I would say most authorities, require you to transfer it on fair market value. So the fair market value is, within theory, the hypothetical buyer and seller. It's not trying to say that absolutely is my buyer, or I have a buy-sell agreement, so this person individually within my company is going to buy it. It's trying to establish within reason, if a buyer gets all free information and full information, and the seller has full information, and they come to a conclusion, that's your fair market value at the end of the day. That is using discounts for lack of control. That's using discounts for marketability. That's taking all things into consideration without the aspect of a strategic, or I would say, inherent value that a competitor would take in. That's your fair market value. That's, I would say, 90% of what we end up doing if we're writing a report. There is fair value. That's going to be more of a financial reporting or legal standard. If you're doing GAAP, you're going to be familiar with fair value standard. The investment or strategic value, that then gets into a whole different, if you want to say a can of worms or so, because a lot of owners will come and say, I would never sell my business for less than this number. And that totally makes sense if you're actually trying to sell your business. But if you're trying to maybe transfer it to the next generation through gift and estate planning, you're going to want to do it on fair market value. It gives you the benefit of taking these discounts into consideration. But that is always tends to be a consulting and education piece from our standpoint, where we're going to say, hey, I agree, you're probably not going to sell it for that, because you're going to sell it to a competitor. That competitor is going to take different synergies and maybe give you a little bit more value than inherently a hypothetical person would. And so that's just the high level of these standards. That's the only thing I really wanted to touch base on. And then, as kind of Mike mentioned earlier, and kind of the questions, we have to always think about, is it a true going concern? Is the trajectory of the business ongoing, or is it going to, in the next couple of years, just kind of erode away? There's certain, like I said, certain businesses that came out of COVID that maybe did not, are not a going concern. And so depending on how those would have been valued at that point in time, or even post, they might be more on a liquidation or orderly or forced. Or if you're, back in the day, if you're a typewriting company, at some point in time, your market becomes so, I would say, saturated and or that you can't grow from it, that eventually you're not a going concern. And so you're going to liquidate at that point in time. So there's some things from an industry standpoint that do that, some things that are company specific that would force you in that liquidation. Characteristics of value. This is really important from the standpoint, this allows us to then usually take the discounts and support the discounts that we're taking. So are you in control? Are you a sole owner? And if that's the case, then there might only be marketability that we're able to take because you already have control. If I'm going to gift in, let's just say 5% to an individual, and I still have 95%. On the open market, or in theory, a hypothetical buyer would not give them the same value that they'd give me for my 95%, even if it's a 1% value that we're trying to establish. They're inherently going to take some discounts on that non-controlling piece. So that, once again, that crux of the controlling, non-controlling interest allows us to factor, okay, what purpose? We know it's going to be a gift. It's going to be a non-controlling. Okay, we know that we're probably going to have to do a certain engagement that allows us to support that. Goes back to that full opinion. We know the IRS is going to be the audience. The marketable, non-marketable, we don't really do public company valuations, but that's where this would be established if you were trying to establish ownership of a potential public company that you could liquidate in 3 days. That's where this kind of falls into that mix. But because we do a lot more of the truly non-marketable, we don't do companies that are on an exchange, we have the ability to take some non-marketability discounts that factor within this. So,
yeah, and I think the only thing I would add on this slide is with this discount for lack of marketability, a common, what we see if we're ever looking at an ESOP or an employee stock ownership plan, the discount taken for lack of marketability tends to be a lot less, despite it being a privately held company. Usually an ESOP has pretty established processes for employees getting in and out of their ownership shares. So it's a lot less, a lot lower of a discount for an ESOP share as compared to just, a privately held company that it would take quite a while for somebody to find a buyer for, say, a 5% interest in this non-marketable company.
Yep, and then that even goes back to, once again, going down the rabbit hole a little bit, is if that buy-sell agreement dictates kind of how you can sell or has some discounts in there, there might be some things that, once again, to Mike's point, has more of a process to this. But this chart just is to kind of give it a high level of how things in theory move up or down depending on what your purpose is. So the first example right up the top there is if you truly own the controlling interest in the public company, and you're able to truly liquidate fairly quickly, that in theory interest would be on a controlling marketable basis. If then you move from I just own one share of Coca-Cola, I'm in a minority position or a non-controlling position, but still of a marketable company. So I can still go ahead and sell that within a short time period, but I really don't have control of that company. So then in theory, there is inherently some lack of control that comes into that. And then you move to the bottom one, which once again, most of the time, this is where we play from a gift and estate planning standpoint, is in that minority or non-controlling, non-marketable basis. Once again, this is where we can maximize our discounting, but it actually inherently makes sense, because if I don't have control of the company, I can't go get debt, I can't liquidate, I can't take out distributions, I can't get my full investment return back, and I can't go to the open market and transfer it in 3 days. Well, inherently, it's not as valuable as someone that has all that control.
And the only other thing I would add here is, obviously these discounts for lack of control and marketability, they seem very hypothetical, which they are, but there is quite a bit of literature out there in terms of quantification. So you can look at, for lack of marketability, there's been numerous studies that compare the prices of restricted stock that later becomes unrestricted or freely traded stock. So there's usually a premium associated with the unrestricted, easily transferable stock, as well as, if you look at the share of stock of a pre-IPO company and a post-IPO company, there's usually a premium on that share price post-IPO, given the ability to quickly liquidate the stock. So there's different studies. You have to take some of them with a grain of salt, but there's definitely some support behind the existence of these discounts for lack of control and lack of marketability.
I think the last thing that we kind of wanted to touch on when we before we get into the approaches, is just this really was established in an IRS revenue ruling 5960. And so that's really where our profession in theory got started. Prior to that, a lot of it was just your balance sheet and whatever from a public company standpoint, whatever was on the balance sheet, that's how people valued their company. That's how you transfer your company. So then this ruling came out and said, well, but that doesn't take into consideration of where the business is going. Doesn't talk about the earnings, doesn't talk about the outlook, doesn't talk about, let's say the workforce, the trajectory of the company, how much you're taking out in dividends. And so there is certain factors that we obviously look at. This is a snapshot of, some of the factors, but at the end of the day, this is what builds in our risk profile. This is what builds into the multiple. And this is what ultimately concludes on the value. But this kind of sets the parameters that say, hey, you have to look at the business, you have to look at the industry, you have to look at the overarching, economy. And then, has there been any sales of these stock recently? And what does it look like, in the next 3 to 5 years, potentially? And so this just kind of gives an idea of the factors and where it started from. And it started from a ruling back in, 59.
Okay, so now that we've kind of covered some of the initial high-level thoughts about, evaluation engagement, some of our frameworks that we must kind of work within, we wanted to go through the 3 primary valuation approaches that serve as the basis for determining a value of a business. So at its core, you can basically boil down valuation as the idea that you want to quantify the value of any future cash flows flowing from an enterprise. You want to quantify that value as of today. So that sounds like the income approach, but in theory, all three of these approaches, the asset, market, and income approach, seek to determine the value today of any future cash flowing to the business. So the asset approach, you determine a value of a business based on the value of the assets net of liabilities of the company. And we'll get into each of these in the next few slides. The market, I always think it's probably the most intuitive method, but you determine a value of a business by comparing the subject business to similar businesses or interests that have been sold. So you'll look towards the public markets or private company transactions and say, okay, if they traded at a certain multiple, in those transactions, that we can infer a value for our business, based off that transaction. And third, and probably the most important, is the income approach. And that's determining a value of a business by converting the anticipated economic benefits into a single present amount. So this is, to my initial point, you kind of want to, this is when we actually quantify any projected future cash flows. What's the value of those as of today? And I think I also want to make a distinction here in terms of, we're talking about valuing business and valuing business interests. So, depending on the purpose, to Ryan's point, if it's a gift or estate tax valuation, we may have to value the business, determine the overall company value, and then from there go down to the interest level or the per share or per unit value. Versus if it's a transaction or maybe part of a buy-sell agreement, we have to determine the value of the business just freestanding, and then we generally don't take as many discounts when you just look at the total value of the business. So, like I mentioned, the asset approach, it's, you look at your assets, you net out your liabilities, and the resulting equity is the value of the business. Usually we use this for a business that's either not cash flowing, so historical losses that's not really projected to change, kind of this liquidation scenario, either on a orderly or a kind of a fire sale liquidation scenario. Otherwise, if the assets are just underperforming, we may have to look at both the asset and the income approach and say, while the income approach may indicate a value of X, in theory, just the value of the assets on a freestanding basis might be higher than that. So it's maybe the simplest approach to value, but I think it's probably the hardest to implement for anything but an investment holding company, solely for the fact that you can't really capture the value of a goodwill component of a business for any type of operating business. So in this case, we just put together a quick example of when we would use this. So I would think of this as if we're valuing, a 1% interest of a investment holding company for a gifting purpose, as in the owner wants to gift some shares to a trust. We may look at the asset approach and say, okay, you got cash and total current assets of $190,000. They have land improvements with an original cost of $5 million that's been depreciated down to $1 million. So if this balance sheet's coming from a tax return, the owner would likely have taken some sort of accelerated tax deduction on these assets. And then say the investments are $1.2 million kind of on a cost basis. So the most common adjustment on this approach would be, when you adjust the land improvements value. So the idea of having a cost basis and then depreciating these assets over time is great for accounting, but it's a little more difficult for valuation in that say in this instance, the owner went out and got a third-party appraisal of the actual property, which they went and found a real estate expert, and he or she appraised the value at $8 million. But then we have to adjust our balance sheet, remove the depreciation, and write up the value of the assets to $8 million, the deemed fair value from market value from the appraiser. And similarly, if these investments are at cost, but the actual market value is $1.9 million, then we basically adjust all the assets and we can adjust liabilities. So, where initially the stated or the reported value was 2.44 million in total assets and total equity of 1.69 million. Once we make our adjustments to this balance sheet, we would end up with $10 million of assets and a $9.3 million equity value. So pretty simple, but like I said, with an operating company, it's something we don't use all that often, simply given the difficulty in quantifying and reflecting the goodwill that is likely present with an operating business.
Yeah, that's a good point. I think the only times that I've seen it is to Mike's point, where maybe the cash flows don't truly justify the value of the equipment. Could be maybe a farming operation, construction, or something along those lines, where the cash flow might be a little light, but they have significant assets, and you need those assets to generate that cash flow. And so it's kind of a circular calculation at the end of the day. I have, in this situation, $8 million worth of assets, but maybe it only cash flows $300,000. The cash flows don't really generate that there's a whole lot of goodwill outside of that equipment. So we have to look at it once again based upon the criteria in order to make sure that we're factoring everything. You got to go all three approaches and try to reconcile it out. But a lot of times in an operating in theory, operating company, the asset approach becomes the floor, not usually the conclusion. So when it comes to the market approach, that's kind of that, I would say, that second where we walk down. We typically go asset approach, market approach, and income approach, mainly because asset approach, once again, it's a little bit more straightforward. You know your assets and you're trying to get to kind of an adjusted book value. Market approach, we look and say, okay, within this industry, is there any really good comparables, either from a public standpoint, where you're in an industry that there's a ton of great public comparables where we're able to go and find that data, or is there enough transactions that these turn fairly quickly, and some sort of database might be able to capture those multiples so we can kind of use it as a sanity check or maybe a conclusion. That's the hope in the market approach. And I would say most analysts would say, I would love it if there was great market data, because it's an actual transaction. It's a third party. It's really good support. Tends to be a little bit tougher from a conclusion standpoint in, I would say, our realm when it comes to writing an opinion on fair market value. Strategic standpoint, and if we're trying to be on the sell side and we're going to take a company out and sell it, for sure, this is usually our start. It gives us a nice range. It's a good conversation piece to say, hey, best in class companies within this industry tend to sell at this. And so this market approach is almost a must when we're trying to sell a company. When we're trying to conclude on a valuation, we use it a lot of times as a sanity check to make sure that we're within the reason and realm on the income approach. But the methods that we look at, once again, I'll go to the public company guideline public company method. This is where we'll look at public comps. What's the price to equity? What's the multiples that I can go in and observe out there? Then the transactions could be public, could be private, same type of things. Which transactions are out there? What can I deem within there that's an EBITDA multiple or maybe a price to revenue or something along those lines that makes sense for that industry. The problem is, once again, if we're going to write a report and put our, in theory, name on that, is geographically, does that make sense? Did they have the same debt profile? Is that public company or private company? Do we know all the information within that transaction? Was it a stock or an asset deal? All that stuff. And so it becomes a little bit hard to use some of this data to conclude. But once again, we use it as really good sanity check. The other thing is, if there's any recent transactions with it, company stock, that's where that buy-sell agreement, or even offers to buy, recent offers to buy, who's taken out from a marketing standpoint. Was there potential acquirers, and what was those numbers? I would say 9 out of 10 times we play in the world of EBITDA. That's earnings before interest, taxes, depreciation, amortization. You'll hear that because it's an easy way to say, I'm going to cut out if this company has debt or not. I'm going to go above that, and I'm not going to worry if they're paying interest expense. I don't know what their tax play is, so I'm going to get above taxes. I don't know if they're accelerating depreciation or if they've bought a company, there's amortization. So I'm going to try to get to the actual earnings of the company, try to get as best as possible, the proxy of the cash flow of that company, so I can apply a multiple that's within reason. The problem is there is some caveats to EBITDA. Not all depreciation should probably be added back. Maybe some CapEx needs to be included into that. The interest expense, that's fine, but okay, are you going to run it with never any debt going forward? Well, no, there might be some expense to that. So EBITDA has to be kind of taken with a little grain of salt. Sometimes you have to make sure that you're taking those extra steps and say, all right, really, what's my cash flow post deal? And then the kind of the last things I want to talk about is, depending on your industry, certain multiples do play out. If you're maybe a financial advisor, it might be a price to commissions revenue. If you're a bank, it might be a price to tangible book of equity. If you're buying a deal and it's maybe from a broker packet, you might see that they're trying to get to seller's discretionary earnings or owner's cash flow. All those metrics should try to, in theory, get back to the same spot. And that is, reconciling back to some sort of a sanity check to this market approach. So the next couple slides are going to kind of touch on some industry data that we were able to find in a specific industry. This is from one of our larger databases. This is S&P Cap IQ. A lot of this comes from public companies, but it's a tremendous database where you can actually drill down to transactions. So we utilize it a lot more on the sell side advisory than we do on the valuation, but it does give us a really good indication on enterprise value, market cap, the revenue, the EBITDA, and it puts it in a nice, I would say, spreadsheet form so we can compare our company to this. But as you can see, even in the public world, the enterprise value to EBITDA is all over the board. Tupperware Brands is trading at a 3.5x, where advanced drainage is 23x. And so if we were to then say, okay, we're going to then write an IRS report using this data, 11x is in theory the median, but is that really what our company concludes to? May or may not.
Yeah. And I should say, with these examples, I tried to just find an industry. I think we're looking at the rubber and plastics products manufacturing industry. So just an industry with some comparable data that we can kind of demonstrate how a value conclusion could be drawn based off this public comparable, public company detail and their trading prices.
Yep. And so from that, once again, that indication, we roll it forward. We have kind of our lower, middle, or upper quartile. And then in theory, we would select a potentially an 8x. So if our company is at, 9 million or 45 million, we're concluding at an indication of, 78, million at that point in time. This just kind of shows an example of a way that you can kind of shortchange. Once again, if you're a business owner and you're looking at, kind of what is my value, EBITDA is probably not a bad kind of starting place. But you really want to take a couple extra steps. One is adjust your EBITDA and make sure that you're factoring all that in. But then two, really potentially have someone run a database like this to say what's a fair range.
Good. And this is the guideline public company, like I said, with the publicly traded comparables. So we seldom, if ever, use this, given, if we look at these companies, the total revenues range from $1 billion to 20 billion. So it's good for comparison purposes. But when you're looking at a company with 45 million in sales and 9 million of EBITDA, it's helpful to know how the industry is operating and how the market is valuing the industry. But we're likely not going to draw a conclusion of value on a business based solely on the guideline public company method. Yep. To Ryan's point, it's more of a sanity check on our other approaches.
And that's very similar to this. This is GF data. I like this database a lot because this is actual transactions from, advisors that are out there, brokers that are out there. We tend to only get the NAICS code, so we don't actually get the transaction data per se, where it's ABC company bought, a different company, but we will get the actual data from the what was the EBITDA, what was the MVEC to revenue, how many transactions, what's the size of the transactions, and this is 10 to 25 million, 25 to 50. So this factors a little bit more in our clientele and in the range that our clientele is going to be. But like I said, we don't actually get the transaction information to where we know that company was bought by that company. So it still is a sanity check from that perspective. So it's a little harder to conclude on value.
And one thing I should have mentioned, but we keep showing this MVIC or MVIC or enterprise value. So that's basically total company value. So you think, the total equity as well as the total debt of the business. I should have mentioned that.
That's a good one. And then kind of I would say our last one that we utilize is our deal stats. The ideal on this one is this gets really small, and you can really drill down on at least the sales aspect. But once again, the tough part about this, if we're once again going to write a true report on it, is, we only have so much information. So you can go from, a plastic sheet manufacturer to an injection molding company. And so to a manufacturer of sliding glass doors, they're all within the same, in theory, family of NAICS code, but it is maybe not a true apples to apple. So it's great data. It's really good to make sure that we're staying within our lines from a multiple standpoint, but it sometimes becomes hard if the industry doesn't have a lot of really, really good transactions. And so then this just kind of ties everything together, and that top part is the deal stats. And so you can see as the lower to the upper quartile, you're going from anywhere between 4 to 8, or almost 7.8. The median in GF data was 6, and then the M&A, kind of multiple from the public was right around, I would say the selected was 6. So we're going to say we're going to take the median from the deal stats and the median from GF data, conclude on 6. On $1.5 million, you get to $9 million. It's really good to know. And the reason that we want to bring this up is, once again, it's wrapping it all together. You got to have the asset approach and the market approach, income approach, in order to actually true evaluation report. The market report, our market approach, is great because it's more than likely actual transactions. So someone within your industry actually sold at that. Now, the variables are different. Might be, like I said, the debt is different, might be a strategic, or might be just an individual that bought it. Those are really hard to sometimes weed out and say, yeah, let's go ahead and conclude on that. But it's really good to kind of know that data is out there. At this point, I will do a polling question.
Now, I would say if you want to get, use this presentation for CPE, Reagan's emails on there, rszatko@lutz.us. So you can email her after the presentation and she will send you a CPE certificate. Give it a few more seconds. Okay, so now that we've gone through the asset and the market approaches, we'll end on the income approach here. And I forgot to mention earlier, but we'll take questions at the end. The income approach is, probably the most important approach that we look at for every, valuation engagement, aside from if we're doing some type of investment holding company. But the two basic methods under the income approach are the capitalization of future economic income or the discounted future economic income. So to the point I made earlier, in valuation, you can basically boil down, what the value of a business is to the future cash flows of a business expected to be generated and the value of those today. So both of these methods try to accomplish that, using an estimate of the future cash flows, which there's a couple ways that we'll get into and how to derive that, as well as a discount rate. We're not going to drill down too deep into discount rates today, but I would say that, in general, that is the required rate of return that a rational investor would require based off the riskiness of the cash flows that we're discounting. So that's kind of a way that we say, in the next 3 years, you're expected to generate cash flows of X. We can use a discount rate to present value those values back to today. And it's kind of built on, you start at you could invest in a government security considered risk-free or close to risk-free. Say that's a 2.5% yield. Plus, you could invest in equity in the publicly traded markets, which historically that's another 6% rate of return that an investor could require. And then you look at the size of the business. So, our discount rates are usually, from an equity perspective, are usually anywhere between 18 to 25, 16 to 25%, somewhere in there. And these examples, we use a discount rate that's called a weighted average cost of capital. So it's an average based off the either current structure in terms of debt versus equity, or an idealized industry ideal capital structure weighting. And that's tends to be lower because the cost of debt is a lot lower, given the interest rate environment.
And I think the only thing that I'd add to the discount rate is, we are using a lot of technical terms here, if it's EBITDA or whatever it might be, but ultimately that discount rate is the inverse, or the inverse of the discount rate is the multiple. And so if you're at 20% from a discount rate, in theory, that's a 5x the other direction, or 20 is 5, 25 is 4, and 33 is 3. It's good to kind of think about that as when we're talking about EBITDA multiples or something along those lines, and we're getting to a 3, 4, 5, 6. The inverse is the discount rate. So when we're talking discount rate, just kind of remember that.
Okay, so first we'll go through the capitalized cash flow method. This is a single period valuation model. You determine the present value of the expected future cash flows, and it's normally used for a company that's stable or not expected erratic growth or decreases in growth in the near term. So I like to think about this in terms of, if you've got a 100-year-old distributor, chances are you're not going to be growing at 30% each year compared to like a high tech or high growth tech business. You'd want to use a discounted cash flow method given the growth projected. So it's kind of a shortcut to the DCF where cash flow is pretty stable from the beginning. So this page, I'll break down these steps here, but basically you start at the company EBITDA, or start at some type of income stream, and then eventually we capitalize it to get to the total company value. So the first step, and I should say that, in this case, I'm starting with EBITDA, but you could start with pre-tax income. You could start with net income. You could start with an assortment of different income streams. But if we start with EBITDA, we're going to look back and say, what income has the company historically generated? And we try to determine an ongoing earnings stream based off that. So while technically, the future is going to be different than history, oftentimes if no projections are available for a business, we have to look back at the cash flows from prior years to get some sort of basis on where cash flows will be indefinitely. So then we'll grow that at kind of an ongoing annual growth percentage to get to an ongoing EBITDA, in this case, 15.45 million. And then step 2 is you have to tax effect the debt-free cash flows. So I say debt-free earnings, excuse me. I say debt-free because, with EBITDA, we added back the interest expense. So we're going to determine the value of a business independent of any financing considerations. I kind of like to think of it as, if you're trying to value a house, you value the house. And if you want to get to the equity, you'll subtract off the homeowner's mortgage balance, which could be drastically different based off a homeowner. So we're trying to capture the whole company value and then reduce the current debt to get the equity value. So given the tax deduction afforded to depreciation, we'll have to have an estimate for ongoing depreciation to get to our ongoing earnings before interest and taxes. And from there, we'll tax affect it because, in theory, any sort of investor would consider the tax implications of their investment choices to get to a debt-free net income. And the income tax of 30% here, that's just kind of an estimated effective tax rate between the federal and state levels. After we tax affect it, we have our debt-free net income, and now we have to consider the actual cash flows. So, depreciation comes back up in that while it's on the P&L, it's a non-cash charge. So we took it out to get to our pre-tax income, but now we have to add it back since it's truly not a cash expense of the business. In contrast, capital expenditures do not flow through a P&L, rather that's a cash flow statement item. So we have to remove the CapEx requirements expected on an ongoing basis for a business. For simplicity purposes, I just net those out in this case because, in theory, your depreciation into perpetuity will, be the same as your CapEx, and that all of your capital expenditures you'll have to depreciate. And the last one there is your incremental working capital needs. So as a company grows at that 3% level, they'll need to maintain increased levels of their current assets, less current liabilities to, make payroll, pay rent, other, ongoing operating expenditures. And then, from here, we have our ongoing cash flows to invested capital. This is where we have our weighted average cost of capital capitalization rate. So that's basically your WACC, your discount rate, less your growth rate. You divide that by the WACC to get to a total company value, or the market value of invested capital value of $79 million. And then, I think that value is, if you sell your business, somebody might give you $79 million, but chances are it's going to be on a debt-free basis. So they write you a check for $79 million, and then you write the bank a check for the $25 million of total debt. So your net equity using the income approach would be $54 million in this case. And the implied MVIC, or market value of invested capital to EBITDA ratio, is 5.3 times. So this is kind of where we'll look at the market and say, where are businesses transacted at? Are we kind of within the realm of reasonableness, based off those prior transactions or the publicly traded comparable companies?
Yeah, so then once again, so Mike looked at from a historical standpoint and capitalized the earnings. This, kind of last portion here, the last couple of minutes, I'm just going to talk about the DCF, or the kind of the future cash flows. The only last piece I'm going to kind of talk on the capitalization side of it is, if you've ever done a valuation report, you've ever seen one, and they've used the cap approach, they may look back 3 years or 5 years. There's no magic number per se. What it's trying to do is it could be 1 year, it could be 10 years. But what they're trying to say is, okay, if we can look in the past and somewhat glean certain years or certain cash flow, and then we can go ahead and capitalize that and put a value to that, let's go ahead and do that. If we can't, if we're growing too much, or we think that we're going to dramatically change in the next couple of years, up or down, that's when the DCF and then the projections kind of come in. And so that's where, on this, it's, used for erratic or unstable cash flows. If you were, like I said, a growing company, you'd be undervaluing it if you used it on a historical basis. If you know that the cash flows are going to be going up or down, you really should kind of go ahead and do some sort of projections, at least 1 year out, maybe 12 months, 18 months, or something along those lines. And that's kind of what we're showing here is, in this situation, is management prepared projections. You don't have to get down to the absolute every expense, but if we can get to some sort of an idea of where maybe EBITDA should be tracking at, if people are doing budgets at the end of the year, this will help us out. But we want to make sure that, especially from an IRS perspective, if that's our audience, that if they have 3 years to look back, that we've at least captured some of that upside, if that's the case. The flip of it is, if you actually think you're going to trend downward, well, then let's not overvalue the company if, unfortunately, the cash flows are eroding away a little bit. So this just kind of shows some projections that will, go over the next 22 to 25, and then I'll touch base on the terminal year in just a second here. We do the same, tax affecting to get to that kind of debt-free earnings perspective, to kind of get to, like I said, that EBITDA, and then we minus out the taxes perspective. Then we look at those same type of non-cash charges, the depreciation, amortization, make sure that we're factoring any capital and expenditure needs. You'll see a lot of times in this situation where we'll ask, hey, are you guys looking to expand or buy another building or something like that, making sure that we are factoring in those depreciation CapEx needs. And then that working capital requirements, same exact things that Mike mentioned a second ago. The difference at the end of the day is what we're trying to do is say, okay, every year is independent of them, of each other. So we're going to want to make sure that we have a present value factor for the most recent years. So in theory, in 22, we're going to take most of that value home. If we think, 7.5 is actually going to be the invested capital that year, we're going to, in theory, say 94% of that is going to factor into our value. That's the most recent year, it's closest. And then as we go out, the discount period gets a little farther, a little bit more risky. And so therefore the present value goes down a little bit. So we go from 94%, 83, 73, 65. What this essentially says is 3 years out, it's really hard to say that we are really going to make 97 million. So there's some uncertainty to that. The last piece of it is we put a terminal on that. So we still cap it at that point in time. And so then the perpetuity starts in theory, year 26. The exact same thing that we did from the cap approach. We kind of capped it at that. We cap it at year 26 from this perspective. That then rolls down. We put the same present value factor that we had in 25. That rolls into our present value of the actual cash flows between 22 and 25, our cash flows on the terminal year, and then we remove our debt to get to kind of the equity value. In this perspective, it was a growing company, so the multiple is now at 6.2 than it was at that 5 million or that 5%. Makes sense. We're growing. You should obviously get a little bit more for your value from that perspective. So that is kind of a high level of all of the valuation, kind of methodology at the end of the day. We wanted to kind of give a high level of why we do what we do from a standard standpoint, our credentialing, what purposes, why there's a difference between a discount for control, why there's discount for marketability. All of it's factored within that, in theory, that ruling, but the ability to say that a non-controlling position isn't the same value as a controlling position. The value as a strategic play, they might give you a little bit more than if I was going to transfer it as a buy-sell to an employee. Hopefully this kind of gives you an overview of all the different approaches. But here's some things that we obviously do, and we've talked several times about. We prepare valuations for gift and estate planning. We obviously help out with some cash flow and projections. So if you need it from an SBA perspective, we clearly do that. A lot of it's consulting on buy sell, or just what is the value of my business, just in general. And so that's kind of where those preparations will come from. There's a litigation side of it that none of us hope that it becomes if you're a business owner, but sometimes it is the case, and we will help with that as well. And then just simply, if you've ever got a valuation done and you want a second set of eyes, we're happy to do that. We apologize, we've kind of rolled up to the clock, but if there is any questions, we'd be more than happy to take it over the next couple of minutes here. And or if you do have questions, we're more than happy to take questions offline as well. All right, with that, we'll conclude it. So we really do appreciate, all your guys' time, and we know that everyone's time is valuable. So we appreciate getting a chance to talk with you today. Thank you.